Hello, everyone. Today on the Final Bar, I'm speaking with Bob Lang of Explosive Options. We'll see what charts he's focused on. We're continuing to track this rotation lower in growth leadership, the three bottom sectors today. Familiar sectors from the top of the list on a normal day in 2023, consumer discretionary, communication services, and technology. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the best practices of technical analysis. The Technical Analysis Toolkit is really designed to help you understand the markets by focusing on what is actually happening. So much of financial speculation, particularly in the media, is focused on what could happen, what should happen, all of these different potential narratives. What's beautiful about price analysis is price is fact. As one of my mentors, Ralph Acampora, always used to enjoy saying, price is fact. You can't debate that buyers and sellers came together at that moment and exchanged shares at that particular price. By analyzing price, we can really try to understand what is happening, what's working, what's not, what's leading, what's lagging, how those emotional drivers of fear and greed really are manifesting themselves in terms of price action. So where are we at here in mid-June of 2023? We've been tracking this rotation away from some of the biggest leadership names in 2023. We'll talk about what I call the phenomena stocks in a little bit more detail today. We'll look at some of those leadership names, how they've been doing so far, what signs of rotation we may be seeing on some of them. A name like Alphabet potentially rotating lower, charts like Tesla with a bearish candle pattern today. What does that tell us about short-term dynamics versus the longer-term trends? We're going to dig into all those charts and more here as we start our market recap. As I mentioned in the introduction, overall, continuing to track the rotation, that rotation defined today with the Nasdaq being down 1.2%, the S&P 500 down 0.5%, the Dow down about 1/3%. For a little while, it was Dow up, Nasdaq down, and the S&P slightly down. Everything kind of rotating lower through the course of the afternoon, finishing more near the lows of the day. This drop has pushed the Nasdaq Composite down to around 13,500. The S&P 500 closing just above 4365. So we are still above 4,300, which was that important breakout level we talked about for quite some time. That was the key Fibonacci level. That was a resistance level from the August 2022 high. Breaking above that, pretty significant. Holding that on a pullback, potentially even more significant, right? We start to break above levels and then fail to hold them on a pullback. Then you have to start to question the sustainability of the uptrend. For now, though, at worst, it's a pullback within an uptrend until we start to see further evidence. We'll see what we can gather from the charts today. The mid-cap and small-cap indexes both slightly down, but not too much, actually close to an unchanged day. The S&P small-cap 600 just below 1,200 points. The VIX is pushing lower, and we've talked about that low volatility environment. I had an interview yesterday with Money FM in Singapore, which was a fantastic experience. Some really good questions about the U.S. market and really thinking about how that relates to some Asian markets. And one of the things we talked about was the low volatility environment, right? 2021, a consistent, slow and steady uptrend on lower volatility. 2022, more of a downtrend on higher volatility. This volatility picture, a lot more like 2021 than 2022. Should that cause us to be optimistic about the prospects going forward? One thing I would definitely look forward to talking about with my guest today, Bob Lang, is that particular idea of looking at stocks versus volatility and what they might tell us here. Let's look at the interest rate environment. Overall, not a ton of change, to be honest with you. The bulk of the curve was slightly down, but not by much. So 5-year yields currently just around 396, 10-year yield around 372, and the long bond yield a little bit higher around 381. Short-term yields, of course, still fairly elevated relative to the rest of the curve. That is continuing that sort of inverted yield curve environment that we've talked about for quite some time. Bond prices using the TLT, which is a Treasury bond ETF, up about 0.25%, and the dollar down by about 0.5% today. The commodity space overall mixed, and I would say in general, everything but the precious metals did just fine today. The DBC is a broad commodity ETF, finished today up about 1.5%. Copper prices sort of unchanged from yesterday. Crude oil, natural gas, both having a pretty strong update. And energy was one of the best performing sectors out of the 11 today. The things in the red on this particular list, gold essentially flat, just slightly down from yesterday's close, but silver down another 2%. So we talked earlier in the week, one of our charts was the SLV, the silver ETF. Same with gold, right? They both have been overall in an uptrend, testing the lower end of that uptrend channel and now breaking down. And that's what's happened in the last couple weeks, right? You're starting to see a rotation. When I think about the potential for stocks and any sort of pullback, that is sort of in the back of my mind. What if we see a similar move to what we saw with gold and silver, which have been in consistent uptrends until they weren't? And what signals could we see on the chart of gold or silver that told us that a rotation was happening? Those are the kind of patterns and signals and indications I would be looking for from our major equity indices. A lot of green on the chart of cryptocurrencies, very news headline-driven market, to be honest, here recently. All sorts of things. If the headline is about regulatory pressures, cryptocurrencies dropping very quickly, all it takes is a major ETF provider talking about, filing a new ETF, and all of a sudden things look really good for cryptocurrencies. Bitcoin up another 6.2% today, and that's pushed us above the 30,000 level. And we talked about these charts here in the last couple of weeks, pulling back to key Fibonacci levels. Ethereum, for example, pulling back to a 200-day moving average. Both of them have now rotated higher, and now those previous highs are once again in play. I'll tell you the same thing we talked about the last time Bitcoin got above 30,000. That's a big round number, which have often had meaning for things like Bitcoin. Can it hold above that 30,000 level? The answer a couple months ago was no. In April, after the move higher, we rotated lower. Is it different this time? Do we hold those previous gains? I think that's the real question now for cryptocurrencies. Let's look at a daily chart of the S&P 500. Just think about what we saw today, how that relates to the longer-term trend. So overall, we can see 3 straight days of closing below the open, 3 straight down days. We've not had a lot of those, a lot of days in bright red in 2023. Now, we certainly have had some, and it's worth noting that already in the last 6 months, we've had a series of drawdowns, sort of in that 5-10% kind of range, maybe a little less than 10%. So what's interesting about the chart of the S&P now is we could pull back quite a bit and still, by some loose definition, be in an uptrend, right? And I think that's what was on my mind with the charts of gold and silver. Are we rotating to the lower end of that range? So I think with the S&P, you think about short-term versus long-term support. In the short term, I'm very keen on seeing if the S&P can hold that 4,300 level. That's that pink shaded area. Basically, it's a Fibonacci level. It's the high from August of last year. And can we hold that on a pullback? Pretty classic technical movement or price fact is that you break out, then you pull back to the breakout level, and that's sort of that initial pullback, and then you continue to rotate higher. And the question is, do you see additional buyers come in willing to buy on the dips? And if so, this makes another higher low, and we rotate to a new swing high. If not, if we break 4,300, if we can't hold that, then we have to start looking at further retracements down. This is where a Fibonacci analysis using the October low and the most recent high could be pretty helpful. This is where looking back at the 50-day moving average at a trend line off of the lows over the last 6 to 8 months could be really meaningful. But first things first, I'm looking at 4,300. It's worth noting this week that the S&P 500 now no longer overbought. It's one of those signs of exhaustion, potentially, is a rally to overbought conditions, and then we come out of that overbought condition. The last time that happened was in August of 2022, and of course, we had a pretty decent pullback after that. If we could, let's look at the chart of Bitcoin here very briefly, and then we're going to look elsewhere. Let's look at the intermarket analysis chart list. Here's the chart of Bitcoin. So what's interesting is the character of this chart has changed pretty dramatically here in the last couple days. Couple days ago, and even over the weekend, as I'm getting ready for, sort of wrapping up last week, I'm looking at Bitcoin bouncing off of 25,000, bouncing off of a key Fibonacci support level and thinking, all right, is this just a little bounce before we rotate lower? It's all about holding 25,000, which we have so far. This could be an actionable pullback. In just 48 hours, basically, we've rotated above the 50-day, and now today almost got to 31,000, and that's the high from mid-April. So just in about a week or so, we've regained those previous highs, and now the question is, can we get above there? I think 30,000 is an important level. For now, we're trading right about there. Can we get above there and stay above there? Worth noting that the momentum has now pushed out of that traditional bearish range and now more in a traditional bullish range. In a bullish phase, charts tend to get overbought and on pullbacks tend to remain above an RSI of 40, excuse me. This is something we've not seen. We've actually seen more of a bearish phase for a while where we're not getting above an RSI of 60 on those rallies. So this is now starting to change a little bit and really telling me Bitcoin, Ethereum now more in a bullish phase overall. Now, if we could, let's look at some of those names, those phenomena stocks that I call them. And what's so interesting to me is CNBC actually just announced their Magnificent Seven. They have created a label, kind of like the Nifty 50, sort of the FANG stocks, with 7 key names in this growth space. And Matt Tuttle is the founder of Tuttle Capital Management, creator of a number of ETFs, sort of commented that this is probably the top. If CNBC is declaring the Magnificent Seven leadership names, that's probably when you want to start thinking about shorting those types of things. Let's look at the charts and see what they've done recently and what they've done over time. We'll go in my loose brief analysis before the show from strongest to weakest. So you have out of these 7 stocks, Meta certainly a strong performer. And when I look at the chart of Meta, I think of the charts of home builders. I think about industrial names like BLDR, like building material stocks that have had just these really consistent runs. Stocks that are still making higher highs and higher lows. To be honest with you, whether or not the entire market looks good or bad, whether or not the market trend is positive or negative, I would argue it's always a good time to own good charts. And the chart really doesn't care necessarily, and the technical analysis shouldn't care about the broad market environment. The chart will tell you when the trend is no longer working. The chart of Meta is still working. Now, how would I define that? If you missed Grayson Rose and I on Monday, we did a Juneteenth special episode of this show called What's a Good Looking Chart? And it started with a joking conversation of, what do you find is a really good looking chart? What does that mean? And we realized it was actually a really good thought process to think about let's define what inputs tell us that a chart is strong or weak. And when I think of an example of a strong chart, Meta is probably one of them. And it's things like we're making higher highs and higher lows. We're above 2 upward sloping moving averages. The momentum has been consistently positive. The relative strength is going higher, meaning it's outperforming the benchmark. Meta literally at this point checks all the boxes. So why would you be bearish Meta here? It would have to be some anticipation that the top is happening before you're seeing evidence of that on the chart. For now, as long as we keep making higher highs, the trend is positive. As long as we keep making higher lows on pullbacks, this is positive. So for me, I'm immediately looking at 260 and saying if we hold that on a pullback, this chart by definition is still pretty good. And I want to get concerned when it's not making a higher low. And that's one thing I would note with the chart of Meta. Looking at Apple, very similar to the chart of Meta, the difference is Apple's literally just in the last couple of weeks breaking to a new all-time high, getting above the highs from the end of 2021, beginning of 2022. Now that is an incredible run. You don't have to tell me are stocks like this overextended because they've run so far so quickly. Hard to argue against that in terms of valuations, right? If you think about valuations on some of these stocks, certainly realistic as the market cap nears $3 trillion. Absolutely, that feels like we can debate overextended characteristics. But do you see anything on the chart telling you that the trend is anything but positive? And I would say at this point, no. So as a trend follower, Meta, Apple, still in pretty good shape. We continue through, and I think we're getting less and less good, but NVIDIA, I would say, still pretty good. What concerns me about NVIDIA, you had this gap higher, and it felt very much at the time like this could be an exhaustion gap, which is a classic thing. At the end of a big move, you have one big gap higher, and it's sort of like that final burst of buying, and then all of a sudden, no one's left to push the price any higher. But we're seeing higher highs, right? After that gap, you had a brief pullback. We didn't even get to the upper end of the gap. We're making it higher. The momentum's a little lower on this recent move to all-time highs, and I think that may be one thing to watch, but overall, still pretty positive. Microsoft, same thing. Now, what's interesting about the chart of Microsoft is you're getting some real extreme movements in the last week and now pulling back very aggressively from that swing. That day, which I think was Thursday of last week, had an acceleration to the upside. The stock becomes overbought. Immediately on Friday's session, we come right back. And then the last 2 days, we're actually seeing lower movement. So again, as long as we make a higher low, this is still okay. But overall, starting to be a little more weaker in the short term. Now we're getting to something like Amazon, right? Is Amazon still a great chart? It's pretty good, right? It's not bad. And I think compared to some of the other leadership names that have had runs, the challenge with Amazon, it's still well behind some of the previous highs. While others are continuing to make new all-time highs, Amazon's actually well below its all-time highs. Recently made an overbought condition now coming out. There's a clear bearish divergence here in the last couple of weeks. It reminds me of the chart of AMD, which has really pulled back after having a similar environment. So Amazon is a bit more of a question mark for me. Tesla is concerning to me because today we have the dreaded bearish engulfing pattern, right? This is when you have a big up candle, a big down candle. Day number two's body engulfs day number one's body. That is a short-term bearish signal on a pretty important name, Tesla. And finally, we get to Alphabet. Now, out of all of these, this is the only one besides Tesla that's actually really starting to pull back a little bit. You have that same bearish momentum divergence May into June. You're now seeing it rotate lower. So I think the bear case for this new Magnificent Seven, if we're going to call them that, is Alphabet and Tesla the beginning of a rotation that we see mirrored or echoed by some of those other leadership names in the growth sectors. That's something I would be certainly looking for here in the coming days and weeks. That's it for our market recap. I'm going to bring on today's guest, Bob Lang, here in a few moments. Before we get, though, a couple of quick announcements. First off, we're doing a free webinar next week on Tuesday the 27th called The Market Top Checklist Revisited. Back in 2021, I did a webcast called the Market Top Checklist, shared with you the indicators and the signals I would be looking for to chart a top in the market. Worked really well at the end of the year when all of those boxes were checked one by one. Thought it was an opportune time to maybe dig that checklist off, see what we saw in 2021, see what we're seeing now, and what signals, what patterns would we need to see to turn more bearish and take some action. Marketmisbehavior.com/top, TOP is the way you can sign up for that free event coming up next Tuesday, the 27th. Also wanted to remind you, our mailbag is coming up this Friday, and we'd love to answer your question on our show. The way you can get your questions to us is via email, thefinalbar@stockcharts.com. We're on Twitter, so just tag us in a comment at FinalBarSCTV. And of course, if you're watching on our YouTube channel, just put a comment below the video you're watching there. We'll gather all those questions. Love to hear from you and hope to answer your question in our mailbag segment on Friday's show. I want to welcome on today's guest, Bob Lang. Bob's the president of Explosive Options, coming to us from the Boston area. Bob, great to see you again. How are you?
I'm doing great, David. Great to be with you as well, too. It's beautiful out here in Boston. It's summertime. And believe it or not, Dave, 75, 80 degrees out right now. So it's pretty nice. School's out and all the kids are out enjoying the sunshine. So am I.
I have such happy memories of time living in Boston with the family. We lived on the South Shore, as we've talked about, and we're from summer into fall. I mean, talk about a gorgeous time to be there. So enjoy it and soak all of that up, of course, as you can. We talked in our market recap, Bob, about this market that, in some ways feels overextended. They've had an incredible run, particularly the mega cap growth stocks. Now, all of a sudden, we're starting to see some hiccups in those trends. We're starting with your chart with the S&P and the RSP. Talk to us about what you're seeing right now.
Well, Dave, this is the comparison of the S&P 500, the SPY, which is a cap-weighted index, versus the RSP, which is an equal weight index of the same exact 500 stocks. So what is the difference here? Basically, the difference is a weighting in Apple is 1 in the RSP, 1 of 500, whereas in the the SPY, the cap-weighted index, it carries a much heavier weight. It's actually the heaviest weighted stock in that universe. So why do we like to compare? Because there's also this bias that certainly recently that only a handful of stocks, Dave, that have been carrying the markets higher. And that's certainly been the case for the Nasdaq. We see a comparison of the equal weighted Nasdaq versus the QQQ, which is the Nasdaq 100. And we see that same phenomenon happening. So I wanted to take a step back and look at the SPY versus the RSP, Dave. And you can see that the red line, of course, is the SPY. The black line is the RSP, which is the equal weighted one. And you can see normally, if you look back in time, the black line or the RSP is normally the outperformer in this case. Currently, right now, that's not happening. So I think that it certainly gives a lot of truth to the fact that only a few stocks are really leading the rest of the market. Now, mind you, if you look back at the end of May, right before June started, you saw that divergence got quite large, and you see a lot of space between that red line and the black line. That still is evident here, but we do see the equal weighted index also catching up with the SPY. So what does that mean? That means more recently there's been participation from a lot of groups, a lot of sectors, broad participation, something you talk about a lot. You want to see a lot of broad participation from a lot of different groups, not just technology, but a lot of different areas, a lot of different groups. So we've been seeing that lately. But I think this divergence here is troubling still, because we do have that separation between equal weight and weighted average. So look, I mean, all it means is that if there's a correction time for those big names, Dave, the ones that you mentioned, the NVIDIAs, the Apples, and the Amazons of the world, it's going to correct hard, and the large index, which is the SPY, which is the cap weighted one, is going to hurt much more than the RSP. A lot of us are invested in the SPY, not necessarily in the RSP, but we're going to see that divergence show up probably sometime probably later this year.
It's interesting. We mentioned in the market recap sort of these leadership names like the NVIDIAs and Apples and others. You know, based on your toolkit, Bob, when you're looking at these charts, do you see anything that would suggest to you to be lightening up if this is something that you would be holding, or are you sort of a trend follower? Let's continue on until it changes. What's your take on, you know, if you do have an active position or if you're following these names, do you see anything that would cause you to change your thinking at this point?
Well, Dave, I'm old enough to remember that. And I'm sure, and I know you are as well, that back in the late '90s during the .com era, I bought into the fact that the stock market never went down. All right, and so I bought that line, hook, line. I bought it hook, line, and sinker, and I went for it in 1998 when the markets got extremely overbought, through 1999 where it got stupid overbought. I mean, I think at one point, Dave, weren't we up to about 26 times earnings on the S&P 500?
Sounds about right.
It was absurd. There was a 6-month period there, Dave, between November and April of November 99 to April 2000, where the Nasdaq was up 80% in 6 months, 80%. And it just got out of control. So the reason why I bring that story up is because I didn't really realize that I could protect myself, that I could take profits, that I needed to take profits. So if somebody's in that situation where they've made money on an NVIDIA or a Meta, beginning of the year, I mean, these stocks are up over 100%. My goodness, if you can't take money off the table, regardless of where the market is at the time, you're ready to get belted like I did in 2000. It took me 3 to 4 years to build an account. It took only 2 months to knock it down. So it wasn't very long at all. You know, I mean, there was one month, Dave, or 1 week, Dave, in April of 2000, the Nasdaq was down 26% 1 week. So you know, I'm in all those stocks, and I got pasted. Did take some money off the table, but I got pasted. Learned a huge valuable lesson about managing risk and about taking money off the table. So if anybody is in these stocks, who knows, like you said, who knows when it's going to end? And it's not for us to determine and make an assessment and say, okay, we're going to pick, August 13th, the market's going to start taking nosedive. We don't do that, right? You talked about price being fact, and that's what we follow. So we follow the facts and follow the leads of the market, and it takes us to where the next trade is going to go to. But I think if you're managing risk properly, you've taken some money off the table, or if you haven't done so, you do it now.
Great thoughts there on money management. We only have time for one more brief chart if we could, Bob, but I wanted to talk about the VIX, right? The low volatility environment that we've been in. We've talked, in 2022, it was all about excessive volatility. We may be seeing euphoria, but we're not seeing euphoric levels of volatility. What does the low volatility, the low VIX level mean for you here?
Well, it simply means that option prices are cheap right now, and because the market is showing a lot of complacency. What I put in those arrows, those blue arrows there, Dave, is showing the separation of the SPY versus the VIX at certain points in time before the market started to break down and volatility started to rise. Now, of course, volatility is in black. The S&P 500, the SPY is in red, and we're at one of those points now, even wider than we were at those three other points. When the divergence got so huge that it had to come in and correct. Look, we all know markets are mean reverting anyway. So at some point in time, it's going to do. Is it going to be tomorrow? Is it going to be next week? Probably not. Who knows? I'm not going to say probably not, but who knows? But all I'm saying is that we're at a point in time where it's critical for you to have some protection, take some money off the table, raise some cash, and step back a little bit. I mean, my goodness, the Nasdaq being up 30-something% in 2023, and we're not even 6 months through the year left. If you've been on the ride for the first almost 6 months, congratulations, pat yourself on the back, take some money off the table, and wait for the next move.
I always tell people, I love to compare it to flying. When you're flying straight and level, everything's good. That's when you want to develop a good emergency strategy, not when the engine cuts out and you start going down. So maybe this is one of those times to make sure your money management techniques are sort of up and ready. Bob, listen, it's great to see you. It was so good to see you in New York for the CMT Symposium. Great to see you again, and I'll look forward to talking to you again soon, all right?
Always great to be with you, Dave. Thank you very much for having me.
That's Bob Lang. Bob's the president of Explosive Options. I love his comments there. I absolutely love his comments about money management and just thinking about, if you've been in these names, it is never a bad idea to make sure you have a really good exit strategy, really good emergency plan. Don't wait for stocks to rotate lower. That breaks my heart when I get people asking a question about a name that's down 20, 30, 40%, and they ask me, what should I do? And my answer is go back a couple weeks and have a much better game plan for if and when this happens. Think about what a downturn might look like for some of those stocks that you're holding and make sure you have a good plan to address that and minimize your downside exposure. Great charts and great comments there, as always, by Bob Lang at Explosive Options. Folks, we have to wrap up the show and go to the 3 in 3. Let's talk about 3 charts in 3 minutes that tell the story of this market environment. Here's chart number 1. We didn't have a time with Bob. One of his charts he wanted to talk about was looking at new highs and new lows. And I think that's an important theme to pay attention to. Particularly, we've had a decent number of new highs, to be honest with you. If you look, this is my new highs, new lows chart. This is the S&P on the top. The second panel down is the new 52-week highs and lows for the New York Stock Exchange, and then new 52-week highs and lows for the S&P 500. What you'll notice until June is there's just not a lot of green. And if there is a lot of green, there's also a lot of red. You had a lot of stocks making new lows, and that is usually the sign of a market that's struggling. Look at what happened from May into June, though. You went from almost an even number of new highs and new lows to way more new 52-week highs. These are your leadership stocks, those names like Apple and home builders and building materials, and names that have had these great runs and just continue to pound away at a new 52-week high. At the peak, over 10% of the S&P 500 made a new 52-week high on the same day. But one of the issues I would be looking for when I'm thinking of my market top checklist revisited is an evaporation of green and a little more red, right? When an uptrend is over, all of a sudden those names leading the way higher sort of start to slow down. You get a rotation a lot of times into more defensive areas of the markets like consumer staples or utilities. They're pretty far off of their new high, and as a result, these breadth numbers start to dry up a little bit. We're not seeing it necessarily yet, but that is certainly one of the charts I'll be looking for to see a change or a rotation away from new 52-week highs. Chart number 2 is looking at the industrial sector. As I was scanning stocks making new highs and lows for my market misbehavior premium members, we focused a lot on the industrial sector this week because that's where I'm seeing a concentration of new swing highs. And it's building materials I mentioned, but a lot of other names in the industrial sector. Some airlines popping up there, of course, and many others. Diversified industrials like GE, for example, that tend to score pretty well. What's interesting about the XLI is if you take a step back from your screen, again, this is what I miss about being in the Fidelity chart room. There's something really cool about seeing a chart taking a couple steps back from this big wall and actually seeing what the larger trend was, the bigger picture. So I would encourage you to get up from your chair, back up a little bit from the monitor, really think about the longer term trend that you've seen here. The industrial sector had a really good run in 2020 to 2021, really hit a peak in May of 2021 and dramatically underperformed the S&P in the second half of 2021, sort of a market performer in 2022, but then outperformed out of the October low. From there, it's been in a basing pattern, but just now rotating higher. 104 was a key level of resistance that's now been broken. We're testing it from above now. Can we get to a new all-time high above 108? That would be my main question for the industrial sector. When a sector is leading, it's often up to those leadership names within the sector to really drive things higher. What's encouraging when I'm looking at the industrial sector in a little more detail underneath the hood is a lot of individual names are actually making new 52-week highs or very close to doing so. I'm highlighting right now our 3 top-ranked stocks using the proprietary StockCharts technical ranking, the scooter rankings, SCTR. Builder, BLDR, which is Builder's First Source, GE, and CPRT, which is Copart. If you look at all 3 of these, Nice consistent uptrends. Again, what makes these strong charts? I would argue Charles Dow Theory 101, higher highs and higher lows. When they pull back, they keep making a higher low, which means you have a pretty clear idea of where each of these need to pull back to or need to pull back above to continue that trend. And as long as those trend continues, why would you fight the trend? Don't fight the trend. Folks, that's a wrap for the show. I want to thank you so much for joining us every weekday after the close for the Final Bar. Special thank you to Bob Lang of Explosive Options, joining us from Massachusetts, sharing some charts and insights with all of us. All of our previous interviews are on our YouTube channel, so check them out for sure. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.